If Trump undermines the independence of the Federal Reserve, what impact will it have on the markets? Imagine this. You're sitting at the forefront of the global financial markets. Momentous shift quietly unfolding before your eyes. For decades, the Federal Reserve has been the beacon of the global economy, earning the trust of countless investors with its independence and stable monetary policies. But now, an unprecedented challenge is approaching. If Trump succeeds in dismantling the Fed's independence, nothing will be taken for granted anymore. How will the markets react? How should investors respond to this sudden storm? The uncertainty this brings is far more profound than any interest rate adjustment or economic recession. It's not just a shift in financial tools. It's a fundamental shock to global capital flows, market confidence, and even the monetary system itself. Let's delve into it and uncover the risks and opportunities hidden behind this transformation. Imagine this. You're sitting at the forefront of the global financial markets. Momentous shift quietly unfolding before your eyes. For decades, the Federal Reserve has been the beacon of the global economy, earning the trust of countless investors with its independence and stable monetary policies. But now, an unprecedented challenge is approaching. If Trump succeeds in dismantling the Fed's independence, nothing will be taken for granted anymore. How will the markets react? How should investors respond to this sudden storm? The uncertainty this brings is far more profound than any interest rate adjustment or economic recession. It's not just a shift in financial tools. It's a fundamental shock to global capital flows, market confidence, and even the monetary system itself. Let's delve into it and uncover the risks and opportunities hidden behind this transformation. Hello everyone, I'm On, a professional investor with over 10 years of experience focusing on the U.S. stock market. Don't forget to hit the like button and subscribe to my channel. Your support is my biggest motivation for daily updates. Or friends, perhaps you don't know this, but the Jackson Hole Economic Symposium has traditionally been the quietest academic salon for central bank governors around the world. People sip coffee by the large windows discussing interest rate models, and an offhand remark could trigger massive volatility in global markets. But this year, everything was different. The atmosphere was tense. Security was heightened far beyond previous years. Conference venue was surrounded by police. Law enforcement patrolled the hotel entrance. And even temporary barriers were set up to prevent any unexpected events. At that moment, many people realized that this year's conference was no longer just a forum for central bank academic discussions, but had been enveloped in a heavy political atmosphere. Early Friday morning, the once peaceful hotel lobby suddenly erupted in a heated argument. A man named James Fishback, a supporter of Trump and a critic of the Federal Reserve, rushed up to Lisa Cook and loudly questioned her about the mortgage rate controversy, causing a scene. Eventually, the police had to intervene and escort him away from the venue. This dignified symposium has always been the most dignified event for central bankers. With only academic debates in the past, this was the first time such a conflict occurred. This scene directly shattered the sacred image of the Federal Reserve, revealing that it is now being dragged into political battles, and the root cause of this is none other than Trump. He has completely torn down the Fed's facade and shifted the focus from Powell to the entire institution. Not only has he launched fierce attacks on Powell on Twitter, but he has also outlined a three-step strategy. Replace Powell, take control of the majority of the board seats, and cleanse the regional Federal Reserve presidents. Since its establishment in 1913, the Federal Reserve has maintained its independence, relying on a dual-track system of the Board of Governors and the 12 regional Federal Reserve banks. What Trump aims to do now is tear down this century-old firewall. Imagine if his plan succeeds. The future pricing of the U.S. stock market will no longer be determined by CPI and non-farm payroll reports, but will be entirely influenced by the political agenda of the White House. This political and financial battle will not only affect the independence of the Federal Reserve, but could also reshape the entire functioning of the stock market. U.S. stock investors will have to face a new market reality, where PolitiFactors increasingly interfere with economic decisions. Today, a tweet suggesting a rate cut caused the market to surge. Then, a comment about firing someone tomorrow led to an instant market collapse. This is no longer just a central bank decision issue. It's the trust system that the U.S. financial system relies on, being blatantly torn apart. Hello everyone, I'm Arvin Powell. It's been 2 days since the Jackson Hole speech. And on the surface, it seems like the market is slowly accepting the expectation of a rate cut in September. But don't be fooled by appearances. This speech's impact goes far beyond whether or not interest rates will be cut. Over the past 2 days, Wall Street's funds have been shifting dramatically between tech stocks, the bond market, and gold, with price fluctuations as if they are being pulled by some force. Why is this happening? Because traders are starting to reprice a much larger variable to risk to the Federal Reserve's independence, and the one who inserted this time bomb into the market is none other than Trump. He's not just applying pressure through public opinion, he has proposed a clear three-step plan to reshape the future of the Federal Reserve. Next, let's break down Trump's three-step strategy. Step 1. Targeting Federal Reserve Chairman Powell. In 2018, Trump personally appointed Powell as chairman of the Federal Reserve. But a few years later, he began publicly attacking him. During the pandemic, Trump called Powell a big dumb idiot and accused him of being an even bigger enemy than China. He criticized Powell for raising interest rates too aggressively and not cutting them quickly enough, believing Powell was slow to react. Now, Trump has stated that if he returns to the White House, he will replace Powell with someone who understands politics. Powell's term ends next year, but the president has the power to nominate a new chairman before that. Step 2. Taking control of the Federal Reserve Board. The Federal Reserve Board consists of 7 seats. Trump has already appointed 2 board members and nominated economic advisor Stephen Moran to join. With the new chairman and upcoming vacancies, Trump could potentially control the majority of the seats. This means that the key decisions of the Federal Reserve would be dominated by Trump, and policies could be adjusted according to the White House's needs. In the future, market attention might shift from CPI and PPI to the demands of the White House. Step 3. Purging the regional Federal Reserve presidents. The independence of the Federal Reserve is protected by a unique system. In addition to the 7 Washington-based board members, there are also 12 regional Federal Reserve presidents. These presidents serve 5-year terms and are selected by local banks and business leaders to avoid political interference. However, Wall Street Journal analyst Nick DeMeyers points out that if Trump wins the election, the terms of the 12 regional Fed presidents will expire in March next year. Trump may alter this situation, breaking the independence of the Federal Reserve. This scenario brings to mind the 1970s, when Nixon pressured Fed Chairman Burns to cut rates for the election, leading to short-term economic improvement, but also causing the high inflation of the 1970s. CPI soared into double digits. The stock market stagnated for 10 years, and the bond market collapsed. The only winners were gold and commodities. The price of gold skyrocketed from $35 to nearly $700, with a nearly 20-fold increase over the decade. The market's biggest fear is not the level of interest rates, but the loss of the Federal Reserve's independence. Once it is tied to political cycles, the trust in the entire financial system will collapse. If you're concerned about the future of the Federal Reserve, don't forget to like, subscribe, and comment. Let me know what you think about Trump's challenge to the Fed's independence. How do you think the Fed's independence will affect future market trends? Trump's three-step plan is taking control of the Federal Reserve Board through replacing Powell, purging regional Federal Reserve presidents, and ultimately bringing us back to a dangerous crossroads. The issue is that, this time, the market might not have 10 years to adjust it, could trigger a new wave of turmoil at any moment. Because if the Fed loses its independence, the market will face enormous uncertainty. The first thing to be impacted won't be interest rates, but the credibility of market expectations for the future. Financial. Markets are most afraid of not the height of interest rates, but the unpredictability of future rate movements. If Fed decisions are influenced by political intervention, market confidence will collapse, leading to 2 waves of shocks. First layer of impact, rising risk premiums. The high PE ratios of tech giants have been supported by the predictability of Federal Reserve policies. Once the Fed loses its independence, investors will no longer trust the stability of the policy and will raise discount rates, leading to a significant drop in stock prices. Second layer of impact. Collapse of long-term assets. Companies like Snowflake and MongoDB rely on future expectations. Once discount rates rise, their stock prices will experience severe shrinkage. The issue isn't with company profits, but with the collapse of trust. Therefore, the collapse of trust will trigger massive market turbulence and undermine the fundamentals. Investors might pull out, leading to a crash in overvalued stocks. The valuation adjustment of tech stocks and the collapse of story stocks will mean that the financial market will face deeper shocks, ultimately affecting the banking system. For decades, banks have profited by managing interest rate spreads and mismatched durations because the market trusted the Fed's predictable policies. However, once interest rate policies become a political tool, the market's trust in the Fed will falter, and the yield curve could invert at any moment. In the short term, banks might not collapse immediately, but earnings volatility will increase. With regional and smaller banks facing higher risks, large banks might be somewhat cushioned due to their size and diversification, but they too face rising financing costs and valuation discounts. The real risk lies in the decreasing certainty in bank operations, and the issue of trust in the dollar becomes even more severe. The reason the U.S. dollar has long held its position as the global reserve currency is not because of America's fiscal health, but because of the independence of the Federal Reserve. If the market determines that the Fed has become a political tool, even if interest rates remain stable, the dollar's position will be threatened. Global central banks and sovereign funds may pivot toward gold, commodities, or other currencies. In short, the pressure on tech stocks, story stocks, bank stocks. And the dollar is not solely due to economic issues, but because of the loss of trust in monetary policy. The de-dollarization trend has quietly accelerated over the past 2 years. BRICS nations have been pushing for local currency settlements. Russia and India have started energy trading using the ruble and rupee. Oil exporting countries in the Middle East have increased their use of the renminbi in transactions. And countries like Brazil and Indonesia are gradually reducing their reliance on the U.S. dollar. While these changes were initially slow, and the market still maintains its habitual trust in the dollar, the situation is quietly changing over time. If the Fed's independence collapses, those countries still watching from the sidelines will undoubtedly accelerate this process. So, what does this mean? First, the trust foundation that underpins America's economic advantage is crumbling. The U.S. can borrow at extremely low costs because the world is willing to buy U.S. treasuries. U.S. tech stocks can enjoy high valuations because dollar-denominated assets have always been seen as a global safe haven. However, once this foundation is shaken, both the high valuations of U.S. stocks and the security of U.S. debt will face serious challenges. In other words, Trump's independent Fed three-step strategy, which seems to be a domestic political struggle, could become the final straw that breaks the dollar's global dominance. If the Federal Reserve really loses its independence, the global capital order could be shaken. As regular investors, how should we respond? Are you also wondering whether to continue holding tech stocks heavily or adjust your positions? Looking for assets that can hedge risk? The answer has already been given by history. Looking back at the 1970s, when Nixon pressured the Fed to loosen monetary policy, the stock market stagnated for 10 years, and the bond market nearly collapsed. However, some investors survived and even made substantial profits. So, what was their secret? They shifted to assets that didn't depend on interest rate decisions. The value of these assets stemmed from deeper demand and trust, not from changes in Fed policy. First, gold and precious metals, which serve as safe havens for trust. Gold has no cash flow, no dividends, and its entire value stems from one word: trust. As soon as the market doubts the credibility of USD OLLAR policies, gold will become the preferred choice for risk-averse funds. In the 1970s, when the independence of the Fed was destroyed, gold prices surged nearly 20 times over the next decade. The situation today is similar. If the market perceives that the Fed's decisions are influenced by political pressure, gold and silver will immediately react. Companies like Newmont, Mining Nem, and Barrick naturally become beneficiaries of this trend. The second, commodities and energy, which represent the value of hard currency. Once a currency trust crisis occurs, people tend to use hard currencies to preserve value. Resources like oil and copper have global demand, which cannot simply disappear due to Fed decisions. Companies like ExxonMobil, Exxon, and Chevron, along with other metal companies, typically see profits rise, not fall, during inflationary cycles. In other words, if the dollar loses credibility, commodity prices will rise, and these companies will profit. Third, U.S. Treasuries and interest rate-sensitive assets, which serve as short-term safe havens. However, long-term risks should be monitored. Although U.S. Treasuries are still considered a safe haven in the short term, if political forces like Trump push for interest rate cuts, the long-term security of Treasuries will be challenged. Currently, global central banks' purchasing power is weakening, and the U.S. fiscal deficit is still expanding. If the world stops buying U.S. Treasuries on a large scale, the dollar's position may further weaken. Treasuries may offer a cushion during the initial stages of turmoil, but they should not be the ultimate safe haven. Lastly, defensive consumer goods and healthcare, which provide stable cash flows. When market confidence collapses, investors tend to turn to companies with stable cash flows and high dividends. Companies in the defensive, consumer goods, and healthcare sectors are representatives of this asset class. Regardless of economic conditions, these companies can always provide basic needs and stable profits. They may not bring in massive profits, but they can offer investors the resilience to survive. In summary, history teaches us that no matter how the Fed's policies change, there will always be assets that provide a safe haven. Gold, commodities, certain treasuries, and defensive consumer and healthcare stocks are all worth watching as hedging assets. When the market is in turmoil, rational investors should position themselves in advance and hedge risks. If you believe these strategies can help you better navigate future uncertainties, don't forget to like, subscribe, and leave a comment to share your thoughts. Your support is important to me. Thank you for your attention. So, as you can see, the logic is clear. Tech stocks and growth stocks rely on the credibility of interest rates. And once interest rates become politicized, their premiums will disappear. Gold and energy rely on trust and real demand, and these two factors won't vanish due to politics. Treasuries can serve as a safe haven in the short term, but in the long term, whether to hold them will depend on global trends. The dollar and defensive consumer stocks are the only defense against market turmoil that can preserve cash flow. In short, Don't just stick to tech and growth stocks, which are premium assets. Make sure to add some assets that are anchored in trust, demand, and cash flow. These are the safe havens where ordinary investors can survive the storm. I have compiled a list of industries and companies that are either almost unaffected by changes in Fed independence or are less impacted. You can get this list by sending the word Fed to me. That's all for today's video. If you found it helpful, don't forget to like, comment, and subscribe. I'm on, and I'll see you in the next video.